So just talk us through what drove that adjustment that you made.
So our expectation for growth is stronger than for many other forecasters. We see a lower probability of recession than the consensus. We see about 25% probability over the next 12 months, growth in the 1.5% range. And the recent numbers have been even stronger than expected on the growth side. Plus, we've seen some higher inflation numbers for January. I don't necessarily think that breaks the trend towards disinflation, but I think it reinforces the idea that the Fed still has work to do. And so we think another 75 basis points from here with no cuts until 2024 seemed like a more likely outcome, and so we made that adjustment.
But when you see things like, for instance, the Fed's preferred inflation gauge coming out later this week, it is expected to re-accelerate. So how much does that sort of thing concern you?
Month to month, it's going to be a very firm reading, probably for core PCE inflation. We think 55 basis points. And that's really driven by what we saw in the CPI and especially the producer price index last week. I don't think, these numbers are somewhat volatile, though. In particular, in January, we had flagged that there was a risk of a January effect, that a lot of prices get adjusted the first month of the year. And that, I think, is coming through here. And we'll see more details, obviously, when those numbers come out later in the week. But I think it is one argument for, doing a little bit more still. And the Fed is moving in that direction, we think.
But it does bring that idea of the so-called no landing scenario back into focus here, where you do have global growth that manages to re-accelerate, but at the same time you haven't generated enough slack back into the economy. So is that something that you're concerned about?
Well, we laid out a narrow path to a soft landing about a year ago. And a narrow path basically means that there's risk on both sides. The economy slows too much and falls into recession, or the economy stays too strong and inflation doesn't come down. We've been, if you look at the entire period, we've continued to be on that narrow path. I still think we're on that narrow path, but right now the risks are looking a little bit higher on the too strong side than on the too weak side. So that's the bigger picture that I'm looking at. But the Fed needs to take out insurance against that no landing scenario, and we think that they're going to do that.
So then do you think perhaps the risks of a contraction could be a little bit overblown, because at least in the bond market, the focus is very much on recession and repricing around that risk?
Well, I do think the risk is lower than what at least forecasters have been saying. The consensus of U.S. economic forecasters is saying a 65% probability of recession in the next 12 months. We're at 25%. That's a pretty big difference. And I would say that the market pricing has evolved in a way that implies less recession risk than it did a few months ago. A lot of the rate cuts that were priced in for later in the year have been taken out of the bond market. So in that sense, I do think the forecasters are quite negative, but market pricing is actually starting to move on a bit.
One thing that's come back onto the table in the last couple of days from the more hawkish people at the Fed is this prospect of a 50 basis point hike. So is there any scenario that you think that would be feasible?
Well, I would never say never, but I think it's quite unlikely that they would want to go back to 50 basis points. Having just moved down to 25 basis points, there was obviously a debate around that, but I don't think we've seen enough information to kind of reverse that decision. It would be a relatively important step, because if they do 50 in March, the market would probably build in at least a decent chance of another 50, and so you need to see quite a lot of information to push you in that direction, and I just don't think that's. We have seen that. We've seen a month of stronger inflation data, but the general trend, I think, is still pretty favorable.
But if you do move to a 25 basis point hike, then do you also have enough to keep financial conditions tight as well?
Well, if you keep going at 25 a meeting, which is our baseline, one in March, one in May, one in June, in that sort of environment, financial conditions, might be sort of relatively stable. And if they're relatively, because it's not too far from market pricing, if they're relatively stable, I do think it means the drag from earlier financial conditions tightening abates gradually as you go through 2023. And that's one reason for why we have an above consensus forecast for growth this year. And again, I think the risk is probably on the side of growth staying a little bit too strong and the Fed having to do somewhat more, and that's why we added the 25 bips.
The US consumer is such a big part of that growth story in the US. So does it concern you when you read headlines, for instance, that credit card debt is near the $1 trillion mark and you have delinquencies that are rising as well?
Well, I do think that consumer credit is a bit of a downside risk. And as you say, credit quality has deteriorated. I would also note that the personal saving rate is at relatively low levels. And it's risen a little bit in recent months, but it's still below the long-term average. So that's probably going to pick up as we go through 2023. And that, to me, points to consumer spending growth at a relatively subdued pace. Now, that said, one big thing is very different this year from last year, which is that real disposable household income is now rising at a pretty strong pace. We think about 3.5% this year. Last year, real disposable income declined at the fastest pace in post-war history. And so this year, we're getting quite a bit more support from income. But I certainly think that there are a lot of cross currents in the consumer outlook, and we think when we put it all together, below trend growth is the most likely.
We're in Hong Kong, so of course a lot of focus today on China. How much is that reopening story a blessing, really, when you have to manage that growth versus the risk that it adds to global inflation pressures?
Well, first of all, if China continues to come out of the pandemic restrictions and therefore the weakness in activity that we saw last year, that's a good thing from an economic perspective in China. And we do think that growth is going to be pretty strong. We're at 5.5% annual average, 6.5% fourth quarter to fourth quarter in China. The spillovers to the rest of the world are going to be positive on growth, especially in the region, in countries that are very interlinked with China. And then they are more also positive probably on headline inflation. We would expect more upward pressure on oil prices from this than what we've seen so far. On core inflation, it's a little bit more mixed. On the one hand, you have a stronger global economy that probably adds to inflation. On the other hand, we're also seeing less supply chain disruptions, and that probably subtracts. So I think that's more ambiguous.